welcome back to The Compass. My name is Derek McPherson. I'm the executive chairman of Olive Resource Capital. With me, as always, is Sam Pelez, president, CEO, CIO, and director of Olive. Continue to, I guess, following up on our last episode, which we did live, which we did from Beaver Creek, and following up on our recent trip to the Denver, or Gold Forum Americas, now they call it, but the Denver Gold Show, as everyone else probably still calls it. You know, want to talk about that. Want to talk about maybe some of the names that we're adding as subtracted from the portfolio, and just kind of what we see out there. Maybe, you know, a big thing for us whenever we go to the Denver Gold Forum or Gold Forum Americas is it's one of the very few conferences where you see the CEOs of the major gold miners all present, and they all present in a row, and they all present in a row on Tuesday morning this year, and so. Sam and I had front row seats or seats close to the front, and we're, you know, sort of anxiously taking notes. Sam, I'll let you go first. Kind of what stood out for you?
It's funny that you mentioned the front row seats, because 2 years ago, you and I were sitting on the front row listening to Paul Brink, CEO of Franco-Nevada, and I think there were 3 other people in the room. This time around, 2 years later, we couldn't get front row seats. We showed up and the front row seats were taken. At some point during that morning, we managed to get front row seats on the far end, on the far left end. You know, certainly not the top seats that you had to pay for them. But you know, it's a good way of thinking about what's going on. Obviously, attendance was higher. Dan Dembo, who's on the board of the Denver Gold Group, mentioned that attendance from the buy side is up over 30%. So relative to last year, obviously much more compared to 2 years ago, but generally a good sign for the sector. We did listen to the CEOs of the large caps and the royalty companies, and there's a few interesting themes that we should cover here. But I think the mood was overall good. There's no desperation for growth, although if you look closely at all the presentations, growth is embedded into their forecasts one way or another. And, you know, I do want to say, you know, thanks to Clive Owen, who sadly has been demoted to the Monday. B2 is not one of the largest companies anymore. But he was very candid and did say that B2 is a growth company and they will continue to grow, and very likely to do an acquisition in 2026. One of the only, if not the only, large cap company that mentioned inorganic growth.
I think Clive has never been someone who's been known to mince words, and at least, you know, in reality, he's on it. He's honest about it. But I think an important factor that I think kind of stood out for me. You talked about people being there. You know, I've been going to these conferences for 10 years probably. You know, something that really stood out to me is this year, both at Beaver Creek and at Denver, is that there were a lot of people that I didn't recognize. I'm not saying that I know everybody who works in the industry or the space, but you generally know the people who are here or people who are around. And so that was, for us, you know, I think that's something that really jumped out at me. Dan Dembo's comments about what was there, I guess what we saw from attendance wise and stuff backed up sort of those claims. I think the other thing that and similar comments from companies that we were talking to, right? A lot of companies meeting generalists as opposed to just other companies or you know, the funds that they're used to meeting all the time. So I think those things really jumped out. Maybe before we get into sort of the growth aspect of it and kind of, you know, growth not being a 4-letter word anymore, maybe we should talk a little bit about what we saw from those majors as far as, you know, the presentations and anything that jumped out at us as it changed our view on any of them.
I think Alberto Calderon, the CEO of Anglo, put it perfectly when he put his slide on balance sheet strength. And he said, I'm not going to spend time on this. Everybody has a great balance sheet these days. And he just immediately moved on. I think that sums it up pretty well. Obviously, with this cash flow generation, everybody has been able to repair their balance sheet, pay down debt. And a key theme for me is share buybacks have been initiated by a number of companies, and those are very powerful in the stock market these days because obviously they're a new marginal buyer, and they provide liquidity constantly into the market, and that obviously has network effects that extend to the passive flows and the ETFs, etc., that pick up more and more of these stocks. So I think it was a theme this year, but I think we're going to hear a lot more from the large and mid caps in terms of buybacks over the next 12 months.
Yeah, I think that was we heard of a few companies, Anglo being one of them, shifting from net debt to net cash, even after all those big purchases that it had made. Kinross, same thing. They were going from net debt to net cash. And I think that's to your point, right? Those strengthening balance sheets mean buybacks. I think, overall, one presentation, we're not fans of Barrick on this program or at all of, not in the sense of whether we like Bristow or not. We just don't think it's a good investment. We haven't thought it's a good investment for a while. And the issues in Mali and otherwise continue to, I think, be a potential drag on that. The risk profile of Barrick's assets overall just tend to be difficult. But I think what caught a lot of people's attention and caught mine as well was Barrick sort of unveiled. They called it, people are calling it a discovery at 4 Mile. They've been discovering 4 Mile for about 10 years. But it's a massive asset, plus 10 million ounces now, big in the heart of the infrastructure of Nevada Gold Mines, which is a company that Barrick and Newmont control. And so, yeah, certainly an asset that, gives Barrick a legitimate, kind of, hey, we've got organic growth, similar to Anglo. And so I think that to me was an interesting tidbit that came out of there. Obviously, Barrick has famously missed on a bunch of inorganic growth opportunities, and famously missed. And so I think that was certainly that was something that jumped out at me is that they do have some organic growth built in. And sometimes these big companies, they roll it out like that. I would highlight that Barrick has had, like I said, I've heard a few people online talk about it as a new discovery, and maybe it's new to a lot of people, but they've been working on it and discovering it for a long time. So,
well, it is very timely because in past few years, all the talk was about copper and Reko Diq, and obviously with the gold market moving, they couldn't show up this year to talk about copper and Reko Diq. So I think it's a very clever repositioning of the company by the management. But there was a key question lingering that nobody has been able to resolve, which is Bristow mentioning that these ore can be processed at the NGM Nevada Gold Mines JV with Newmont, and that's not how these JVs work. You don't just bring ore from your own mine and process it there. So that left a lot of questions as to whether Newmont is going to be invited to the development of 4 Mile and integrated into the JV, or perhaps there's going to be a transfer of ownership from a JV to a single owner, or who knows? Like, there's a lot of opportunities there, but I found it quite interesting that Bristow left that up in the air, without any more clarity. Now, obviously, this is not going to be. The mining doesn't start tomorrow. There's time here, but certainly lack of clarity as to exactly how he envisions this whole thing moving ahead.
Yeah, generally, Nevada Gold Mines isn't going to process it for free. So that's the I guess that's the angle. I think overall, sitting through all those presentations, I think I guess maybe two key takeaways for me was that still like Anglo the best. Still like what they're doing and how they're approaching things and what they are doing as far as moving the company ahead. I think they're aggressive in the right ways and in the right places, and then also we're aggressive at the right time, right? Their acquisition of Centamin could not have been more perfectly timed. It's probably paid for itself in cash flow already, just based on the move in the gold price. So continue to like Anglos are kind of our favorite big cap name. Second thing that really jumped out and I think it's worth delving into a little bit, is that, growth wasn't a 4-letter word, or isn't a 4-letter word anymore. And I think that's a big thing. 2 years ago or even a year ago, everyone was talking about, reinvesting in their assets and how low their discovery cost was and what they're doing to, enhance their existing asset profile, and how that was benefiting shareholders and, return on equity and really kind of metrics that generalists like to hear. Whereas I think, as previously noted, other than Clive Owen at B2, no one else, kind of explicitly said, "Hey, we're going to go buy something." But everyone seemed open to opportunities. Some between the fireside chats and the other thing, I don't think even Agnico, who probably has more organic, as much organic growth as anybody, and is excellent at it, weren't opposed. They were very specific about what they would be looking for, but were not, generally opposed to the idea.
I found, what the companies are saying is a little bit inconsistent with what they're doing, because obviously Newmont is coming off this massive divestiture program. Barrick, I guess, didn't surprise the market, but, announced the sale of Hemlo during the Beaver Creek Gold Show. So the two largest miners, actually, I guess Agnico's bigger than Barrick now, but two of the three largest miners have actually been divesting assets. None of the three have been actually growing by acquisition. To your point, Agnico doesn't have to. They have so much embedded growth organically. But I think maybe this is just preparing the market for the future, giving a heads up that growth's going to come one way or another, and not to be surprised if we see announcements over the next 12 months to that effect. I want to say two things before we continue. One is we still like Anglo the best, and buybacks have proven to be such a powerful element in this market, and that Anglo hasn't started doing buybacks. Presumably they will in the next 6 to 12 months. So that should be another positive catalyst to the story. Like you said, they're net cash now. Well, near net cash on June 30th, but nearly 3 months later, you can obviously assume they're net cash at this point. And the second one is on the subject of inorganic growth. You sit down and you see the presentation by Agnico. Their top assets, Detour Lake and Canadian Malartic, were acquisitions. Agnico didn't have a single percentage point of those assets when they were being developed. Now they own them 100%. And if you remember, Malartic, they had to buy twice, two parts, in two separate transactions. But I think it's a good case study to demonstrate how growth via acquisitions can be extremely profitable and accretive to a story. If done well, if executed well.
And I think the way Agnico has made money for shareholders on those assets, in particular, is not in the purchase, but in the reinvestment. They used their strong balance sheet to reinvest in what were struggling or underinvested assets, and made a huge difference. Right? Both that Malartic camp and the and Detour Lake are going to be 500,000 to 1 million ounce type assets, which are very, very rare in the gold space. But a lot of that came from their, heavy reinvestment, which is what a lot of companies have talked about over the last little while up until now. So I don't know. I think it would be, looking back at that on that growth side, Clive was very specific about growth. He said he wasn't going to buy something in 2025, but they probably look at something. They might do something in 2026. There's probably 100 things they could buy. But do you want to throw out some ideas here for the crowd as to what what B2 buys?
Well, there's things that they have existing investments in, Snowline, Orion with the JV. Let's call it the Rupert Orion Finland camp. It's a possibility, although I think that doesn't depend 100% on themselves. And then there's the top of the crop takeover targets right now. Troilus, which we own, Omai, which we own. And I think actually there's not more than 5 or 6 real tangible opportunities for them at this point. I would mention that, West Africa should be, there's plenty of great opportunities there. And that would be an area that I would put top of the list, except for the fact that that's been the source of the disappointment and the risk. And buying there will be contrary to sort of the common trend that we're seeing now, which is upgrading jurisdiction. And presumably they're going to go, North America, Europe, or Latin America, which are conceived as better jurisdictions than West Africa, of course.
Well, I think that's a great point. I mean, to be honest, they literally bought I don't want to say a lower quality, but a lower return asset in Sabina, Goose Bay or Goose Lake. I forget which one it is, but Goose. But they bought a lower return asset in that to improve their jurisdictional their risk profile jurisdictionally, and so I think that is, I would be very surprised if they, like as you said, I'd be very surprised if they went back to West Africa, so you can sleep at night.
So if you look at our portfolio, it's pretty well positioned for somebody like B2 and others that will come. Again, one of our key investment themes is ready to build, sort of. I think both Omai, Troilus fit into the category. To some extent, the Rupert Orion camp also would, albeit with a little bit more permitting required, but still fits into that category of assets that could or will be built in this cycle.
Yeah, I think that's a fair approach or a fair way to look at it. The Rupert Orion camp it's going to be a long cycle if they get built the cycle, but it's a high quality asset and would get built off cycle as well. Those are rare. I guess, shifting a little bit from what we learned at Denver Gold and what we thought was interesting there. And maybe just to back up 30 seconds before we jump into sort of some names. One thing I would say is that those names that B2 could potentially acquire are also names that everyone else who growth isn't a 4-letter word for anymore could also acquire. And I think that's an important point. Not everyone is going to, kind of put it out there like Clive is or be that straight ahead. Whereas a lot of the other guys are in kind of maybe in the same boat, whether it's this year or next year. I think that a lot of them are looking at opportunities and rightfully so.
Right.
So what everybody wants to know is, we teased it a name in the last episode. We also, obviously met, we probably did between presentations and meetings. We probably saw 30, 40 companies in Denver. You probably saw another 30, 40 in Beaver Creek. Come away from this conference, we gather all this information in. When we look at it as what justifies a conference for us is the investment in one name. One good name pays for everything. And I think we figured that name out from an investment perspective. So I would say drum roll, please, but I don't think we have sound effects on here yet. We'll put that in we'll put in a request for sound effects for next season. But over to you.
We love this kind of concept of we've seen this movie before, and I think we have found an opportunity here that precisely fits that category, and it's Bellview Gold out of Australia. BGL is the ticker. Now, Bellevue is an asset that's been well known. It was developed over the past 5 years. It's run by an ex-Northern Star, Darren Strello. Today is about 3.5 million ounces at near 10 grams. So ore body wise, it ticks all the boxes. And what's happened with the story is over the cycle, over the last 5 years when they were building, there was a lot of hype behind the story. With that type of ore body in Western Australia, obviously drew a lot of eyes to the story, the Northern Star Association. And frankly, for us, the entire time it was too expensive. It was just, too many expectations baked in. Lo and behold, 2024 comes in, they start production, and the stars align for everything to go wrong at the same time. They had fallen behind on mine development. The balance sheet was strained. They had a ton of hedges on that were part of the project financing package. and then they had a flood due to unusually heavy rains for Western Australia. When you put all of that together, productivity diminished. They missed a few quarters, and the lenders triggered some covenants and effectively forced some repayments, which naturally means forced balance sheet repair. That happened in April this year, and obviously at that point we got interested. We started researching the company, listening to the conference calls, and effectively what's happened since is they raised a ton of equity, diluted the existing shareholders, made some repayments to the lender, including buybacks of most of the hedges. Now, the hedges were at the, when they put the project finance together, I think gold has doubled since. So their hedges were pretty punitive at this point. But fast forward to today, and what do we see? They've caught up on mine development. They've repaired the balance sheet, obviously, effectively no leverage except some remaining hedges, but pretty manageable from that perspective. And most importantly for me is when you look at the mine sequencing and the mining areas they're going to target next, they're finally going to go for the mining blocks that are within the resource model grade. Because previously, as they fell behind on development, they had to mine blocks that were, sort of like staged for later in the development because they're lower grade. So now, they have 5 mining fronts open on 3 different ore bodies. Productivity is going to increase. And they've promised the market that next year they're going to produce 170,000 ounces. In my mind, they're being conservative. I hope they outperform and outdeliver that number. But this is a company that has a market cap of give or take under $1 billion US that can produce, based on the facilities on surface and these 5 mining fronts, they can produce 200,000 ounces in Western Australia of extremely high grade gold. That to me, when I look at the comparable universe of investments, is worth well north of $1 billion US, probably more in the realm of 2 to 3. And I think we are, sitting in front of an opportunity that could re-rate to the tune of 100 or 200% on this gold price alone.
Yeah, just to take it back to, we've seen this movie before, right? High grade underground mines often struggle when they start up. It's, you name the mine, it's struggled. Very, very, very few startups smoothly. And inevitably, when you're a multi-asset when you're a multi-asset company, you can hide that. You have cash flow from over here to fix this over here, fix that over there, right? Whereas if you're a single asset developer, it can be a disaster. We watched Pure Gold go through that and blow up. We watched Pretium go through it, but they had enough grade to get by and then and work it out. But, we watched, back to early in my career, Lakeshore Gold, underground developer, rushed into production, balance sheet is tight, not as much infill drilling as they should have had, not as much development as they should have had, kind of hand to mouth to feed the mill. And then, took some pain from a financing perspective to get things cleaned up. Then we're able to take the time to actually turn the assets around. And I think that's exactly what we've seen in Bellview. And so, in that Lakeshore example, that was in a much harder time in the market, but that stock went from, it bottomed at 15, 20 cents, and, got taken out north of $2. And I think that, this is a better time in the market. And so Bellevue's starting at a higher value, but I think that, there is the hard yards are behind them. And now it's just a matter of executing. And a lot of the risk has been taken off the story, right? For us, risk just isn't, whether, jurisdiction or, geologic risk or whatever. Risk is oftentimes market cap as well, right? Because if we buy in at a higher level in the story, we are taking the risk that it could pull back on it. That if there's any issues, it's going to pull back, right? Whereas, now that this has had the washout trade, it had the hand in hat financing to fix the asset, it should be this should really start to move. And so it's a name we'd like, and as Sam kind of prefaced, we've seen this movie before. This is how these turnarounds happen, and particularly in Western Australia, where everything is so expensive relative to North America, this is an asset that isn't. And roughly speaking, just for reference, I think this is a good comparison. This is roughly the same. This asset is roughly the same size as Hemlo, a little bit higher grade, and now has less balance sheet leverage. And Hemlo just got bought for $1 billion. So I think that's a very good comparison. But I think that, whereas Hemlo, these guys are just taking over. They're going to have to reinvest in the asset to get it, because obviously Barrick's probably underinvested in recent years. This is an opportunity. Bellview just seems like an opportunity. We're on the other side of that reinvestment curve.
Another theme that we typically talk about is sort of like underappreciated kind of expenses or capex that's already occurred, and that's the case here. The asset is fully built. The productivity is going up as we speak, and it's all about accessing the right blocks with the right grade. They're already entering into those zones, and the transformation, for those familiar, Saracen was doing the same thing at at Karasudam back in 2017. That stock went from 43 cents the day I was on site, very quickly went to $2, and ultimately I think the merger with Northern Star, but with other precedent transactions was at $6. Wesdome, again 2016ish maybe, $2 stock. Then they rediscovered Kina. If you remember, the label as a new discovery is just the rediscovery of Kina. But what ultimately really moved the stock was they were accessing a much better mining area as prices were increasing. That stock in that cycle went to $13. So when we say we've seen this movie before, is there are many precedents of similar situations. Caveat, not all of them work. There is still risk involved in this. Obviously, it's still in a turnaround phase, but we think the key ingredients are in place for them to deliver on the plan at this time. And after watching the story for 5 years, we finally found the entry point, right as the previous expenditures are, in our view, are underappreciated.
Yeah, I think that's a great point. And those examples you gave, Wesdome or the other ones, or Saracen.
Yeah.
Those are like, you get to this point, right? Particularly those higher grade ore blocks. The other thing that really helped the Wesdome was at Eagle. They hit those wider zones at depth that were higher grade, and all of a sudden, and actually, interesting part about Wesdome is they just went through a cycle where they, part of the reason that the stock was off and is now coming back is that they went through a lower grade and narrower zones at Eagle, which hurts productivity and grade, and then goes up. And so these underground mines, especially small underground mines, which Eagle is for Wesdome, they go through these cycles. Bigger underground mines like Bellview, once you get the development place, they're able to control it a little bit better as far as grade control, etc., because you have flexibility to move around and kind of keep your head grade constant. But I think that I think this is like I said, I'm excited that we're invested. I think it's a great opportunity, and I think that it's, as noted, we expect this thing to re-rate, and if it doesn't re-rate in a timely manner, I expect it to get taken out because it's so much cheaper than everything else in the market, and they don't make 200 up to. I mean, they're guiding to 170,000 ounces a year at the top end, but I think 200,000 is probably within reach with a little more investment. So they don't make 200,000 ounces a year underground 10-gram underground ore bodies. They're not a lot of them just kicking around. So I think there's if it continues to trade where it is very high likelihood it gets taken out. And the downside risk protection for us is if it struggles, we have a good gold tape from a commodity price perspective. There's good sentiment out there, and so it's got some downside protection as well on that basis. Much like much like the tech trade over the last 5 years. People are going to be buying dips for sure when they occur. That sort of wraps up the time for us. We only talked about the one name and a little bit of what we saw at Denver Gold. You know, a couple of notes: the platinum palladium trade that we've talked about a couple of different times is really moving, particularly Chalice. I think there's some other good news bits out there. What we're seeing, the other thing we're generally seeing in the market is a lot of financings, which, you know, moves projects ahead and advances them and allows projects to get to the next stage of development. So those are all things we might talk about in future episodes. But I think for this week, I think we'll leave it here.